published The Intelligent Investor in 1949. If you're, I consider using that as a textbook for the course, but it's in kind of an old-fashioned English grammar, and it's a little difficult. The father of value investing, he believed in solid fundamentals, intrinsic value versus price, and margin of safety. He was Buffett's professor at Columbia University. The myths of investing. You have to be an expert to manage your money and investments. It's a myth. You can't beat the market. It's a myth. It's not true. The best way to minimize risk is to diversify and hold for the long term. Wrong. Rule number one. There are only two rules to investing. Rule number one is don't lose money. Okay? Rule number two is don't forget rule number one. Pretty simple. I don't mean to be flippant, but it's pretty simple. Rule number one, investors know the value of wonderful businesses and they buy them when they're underpriced. It's like trading mules. Buy them when they're cheap. You try not to buy a blind mule. Don't buy a bad stock. You want to own businesses that are going to give you an appreciation of about 15% on the average all the time. Knowing you will make money comes from buying a wonderful business at an attractive price. So you have to be able to compute what's it worth. And we're going to spend a lot of our energy this semester helping you to understand how to do that. Price is whatever Mr. Market says. That's simple. We can look it up at any time. Value is more complex, but we can do it. Now, I invite you to bring your laptops to class because we have wireless in here, and because we'll oftentimes be using the internet, and you can do it yourself. And I'll ask you to do things for me during class. The 4 M's, meaning only buy stocks and businesses that we understand. Moat, does the business have a durable competitive advantage? Because there's going to be competition. If you're making lots of money, other people want it. Management, do you share the values and visions of top management? I won't own some companies. I won't own companies that are involved in pornography or the sale of alcohol or tobacco. But that's just my thing. You know, you have to decide what your values are. Margin, and also gambling. I won't own a gambling company, and boy, that really causes me to check my discipline because they make a lot of money. Margin of safety, only buy when Mr. Market offers the stock at half or lower than half of what you estimate to be its value. Meaning, I've already talked about that. Stocks. What to buy? Well, we could get stocks. They could be large caps, small caps, domestic, international, of established markets or emerging markets, blue chips, technology. And if we insist upon buying mutual funds, and I want to put a big, isn't that what you do to keep a vampire away? No load, just forget them. Bonds, CDs, exchange-traded funds. ETFs have many of the characteristics of a mutual fund, but you buy them and sell them like a stock, and they're very cheap. Commodities, real estate like gold, copper, the leading indicator of the market. The leading indicator of the market is copper. If you want to know what's going to happen in the market 6 months from now, look at the rate of change of the price of copper. If copper is going dramatically up or dramatically down 6 months from now, that's what's going to be happening in the market. Real estate. Now, you can buy real estate like a house, a rental house, or you can buy a REIT, a real estate investment trust. Did you know over the last 24 months, real estate investment trusts have been one of the best classes of investments available? Some of those REITs have been giving 30% annual return. These are companies that build shopping malls and subdivisions and major big companies. The 10-10 rule, I won't own a business for 10 minutes unless I'm willing to own it for 10 years. We're going to focus on the big 6 numbers. Return on invested capital, sales growth rate, earnings per share growth rate, equity or book value growth rate, free cash flow, and debt to equity ratio. Those are the big 6 numbers. And that's how we're going to decide whether or not the company is worth owning. And then we're going to use that data to estimate sticker price. We generally don't like debt, just like I don't like it in my own life because it inhibits my ability to do things. So it is with a business. Borrowing is a habit to be resisted. Excess cash should be plentiful. Go look at Apple's. What's Apple's current debt? 0. Okay. What's their loan history? They haven't borrowed money for so long I can't remember. They just generate what they need. It's a well-managed company. And it will continue to be a well-managed company. Debt to equity ratio is the 6th number. Hire the best CEO. When Steve Jobs died, me and my class went into mourning. I'm still in it. But iPad 3, iPhone 5. You know what the iPhone 5 is going to have? I don't bring my phone to class, but it's going to have a holographic keyboard. You set it down there, keyboard's going to go under there. It's going to have a holographic display. Display is going to just pop up. You want to look at it? Would you like to have one of those? What about Siri on that 4S? If we could just figure out a way to design products so that everybody's got to have one, and nobody has had one before, and just do that over and over and over, think about it, you know? And there are a lot of companies like that. We're going to learn how to find out how stable, how good a company is. Does the CEO and other top managers own and retain stock in the company? That's the way they should be paid. If they got big salaries, well, they're just in it for the money. But if they're getting paid with stock, not stock options, but with stock, then they're on our side, you know? Know the vision, values, and purpose of the CEO. Okay, margin of safety. Price is what the market is getting for the business today. Value is what it's really worth. Margin of safety is half of the value. So we know that we can't estimate intrinsic value or the value of a stock exactly. We can't do it to 4 decimal places. It's an estimate. So we take half of that, and that tells us at what price we could buy it safely. It's a margin of safety. Like when you design a structure, you understand the margin of safety in a structure. Knowing when to buy, knowing when to sell. Profit's not a 4-letter word, you know. It's okay. In my investing service, I'll say, well, you know, sell half of your shares in Apple or whatever at 405, put a day limit order in, and sometimes they'll write back, well, why? It's still going up. Why do I want to sell now? Well, don't you like profit? Take a little bit of that off the table, you know. Keep some, but sell some. Sell when the market overprices your investment. Sell when price exceeds sticker price. Be disciplined. We'll talk about technical tools. I'll show you how to do it. I'll introduce a new tool that we've developed in our research, which we call the 4th tool. Have a plan. Decide on the type of investment appropriate. Develop a watch list. Start slow. Avoid emotion. Emotion is what prevents a lot of investors from being investors. You got to check your emotions at the door. Have fun or don't do it. If it's not fun to you, then don't do it. Now, in the class, you got to do it. You know, but I mean, after the class, just don't do it.